Greetings and salutations, everybody, and a happy new year to everyone either coming to CoveredCall ETF investing for the first time, or you've been a regular viewer and just coming back to the channel for the first time here in 2025. So let's do something we haven't done in a long time, which is talk about the yield and distribution changes on the Canadian CoveredCall ETF landscape. We'll go through each fund manager, just highlight some of the more notable month-over-month changes, and look to see what trends, what weaknesses that we're starting to see in the marketplace, what's percolating, so that we as income investors can take advantage of these opportunities that are out there. And which obviously, by the way, I'd be remiss if I didn't mention I am running this big giant 1 year anniversary fire sale on the CoveredCall ETF All-Star Tracker, which is this, what we're looking at here. A spreadsheet I've created for income investors to have a nice bird's eye overview with live data, with changes coming every single month that I put out on the first of every single month. So you have at least the most relevant, up-to-date information over not just the Canadian landscape, but the American landscape for income investing as well. So 68% off, $50 for 1 year. Where does that 68% off come from? That's if you were to join my Patreon and get the full tracker every single month. It would end up being, I think it's something like $156 for the whole year, but you can get it for the month of January. It's $50. It will rise after January. So if you're interested in what you see here, I believe every income investor really should have this, especially at this price. It's worth a shot, I think. Yeah, I'm a little bit biased to it. It's my product, but it really has some amazing detailed information in here that I think will be really handy for you all, especially if you use it for the whole year. But anyway, in the description below, click on the link. It's going to bring you to Calendly, which is a scheduling tool I use for Zoom calls, Zoom chats, whatever you want to call it. This is the best way I can get this deal to you guys. I can't do it through Patreon. It won't let me do the kind of discount I wanted to do. So this is just another means in which I can get it to you all, probably the easiest and quickest. So once you click on it, you'll see a time. There's no event going on. This just gets you the link. Name, email, credit card information. I don't see your credit card information. I don't want to see your credit card information. There's enough numbers rattling around up here. So it uses Stripe, which is a big, secure credit card transaction platform. Same with Calendly, very popular amongst content creators for doing coaching and this kind of stuff, and for any online business really. So you got two just massive platforms here that are in use, and many people that have picked up this tracker have used this as well already, and no issues so far, none on my end for the entire time I've used it, and so far nobody has contacted me about any issues on their end. So with that being said, pick that up if you're interested. Let's get into the main meat of this video. So we'll start with BMO, biggest AUM provider for CoveredCall ETFs. I don't think it shouldn't be a big surprise or a big six bang. They can honestly package a lot of these CoveredCall ETFs into their own, bundles, maybe some of these products together for themselves. Who knows what other kinds of products that they offer that some of these ETFs might be stuffed in. I don't know for sure, but it's a little bit of speculation on my end when it comes to that. But if you're looking for modest yield, in the 5 to 10% range, BMO might be your place. Very conservative management strategy with BMO, I would say. But anyway, what are some of the big highlighted changes that we see, the month-over-month yield changes? Well, we can see that U.S. banks has one of the biggest changes. Not that it's going to be probably the highest yield, but it'll give you a good indicator of the fact that it started the year, and keep this in mind with financials in general, started the year at 9%. As the yield decreased, that no doubt meant that what was increasing, unit price was increasing at that rate, all the way to a bottom of 6.56%, and then we see a big jump. So even just in the last month alone, a lot of weakness in the marketplace. this is going to be a trend that you're going to see here with financials. What else is what else is something else that we're going to be looking at as well? I think utilities is going to be another one. This will be just another sector that is interest rate sensitive. And especially now that interest rates are kind of in the spot of they're not necessarily going to be lowered as much as they maybe have been anticipated, at least on the American side of things. Here in Canada, we continually, we're continually cutting rates, but as far as I'm concerned, from my understanding, we don't want to deviate too far away from the U.S. or else our dollar crashes just that much harder. So Canada in a bit of a bind right now when it just comes to continually lowering interest rates. Will we continue to lower them? I suspect so, but as long as the U.S. can also lower theirs as well, then we probably stay relatively in lockstep with them and not get too much farther away from them in that regard. Okay, so we've kind of looked at BMO a little bit, U.S. banks, utilities. Energy is probably going to be another one that we'll obviously highlight as well as something to pay attention to. So the next one we'll look at is Brompton. There's really only one fund here that I really wanted to highlight. BMAX, which holds all these other funds in it. I gotta say, in a lot of my interactions, nobody seems really all that interested in these individual CoveredCall funds by Brompton. But it's usually BMAX. BMAX is by far the most popular of all these funds. It takes into account all of these sub funds, sticks it all into one place, and then you get BMAX, right? The Enhanced Multi-Asset Income ETF. It's got 33% leverage on it. I own it. It's been a staple in my portfolio for a long time. It's I like having it there. It's a nice buoy. It really does. When markets seem to fluctuate, you get extra volatility. BMAX seems to be pretty steady. So we get 10.12%. That for BMAX is a high. You can see it's usually 9.5% to 10%. 10% seems to be that target yield for BMAX. I believe they did 2 distribution increases last year to obviously help offset, as the price was climbing, yield was dropping, and I think it just made sense. It made sense for BMAX to elevate that yield to get it back within that 10% range. Also, I believe what's unique about BMAX is that they lock in the distributions for 3 months. So you'll get a distribution declaration, but you get it for 3 months. So if you subscribe to their newsletter, you get the emails, the updates for distribution. For distributions every single month, but even I believe on their website, you'll see it for future months. I believe so. You can obviously in the comments correct me if I'm wrong, but I'm pretty sure that is the case with BMAX and just Brompton in general. You'll get 3 months of this distribution or a particular distribution. So elevated yield, 10.12%. I like 10%, as many of you know. So hey, there could be, I think, BMAX solid fund. It's got a little bit of fixed income in it. Many of you know I'm not thrilled with fixed income. If it's in a small portion in a very diversified fund, I'm more interested in the diversification of the strategies and leadership styles, and having access to a Brompton fund, just to have a little bit more fund manager diversification there. I'm more interested in that, and that overrides the small amount of fixed income, at least for me, on that end of things. So multi-asset income ETF, you know what, seeing a decent yield there. So I wouldn't turn a blind eye at BMAX. Definitely worth some consideration. Okay, what do we got next? Let's do CI. CI has, well, their yields, boy, do they jump around like crazy. That is insane. Look at that. Gold. Okay, so the CI Gold and Gold Plus Giants CoveredCall ETF. Wow, what a massive increase. I don't know if we're going to see a yield increase amongst the other fund managers, quite like gold mining. I do believe other ETFs we will touch on. Mining in particular has seen some struggle over the last month or so. But overall, many of these gold mining covered call ETFs have actually done really well in 2024. So to see this is actually quite the surprise. And you can see that this is not historically, since I've been keeping tabs on yield. This is not a this is quite unusual. Has CGXF really deteriorated that much to go up 50%? I don't know about that. There are some things I must mention about CI before I talk about some of these other funds, because I am seeing it for the first time. When we go to look at these other fund managers with the yield changes, you're not going to see such a large increase in yield from diversified sectors quite like CI, and they're into the same sectors that you're going to see from the other fund managers: tech, utilities, energy, financials. And already there are some things with CI. I am curious to know if there are some changes behind the scenes that maybe aren't as public. I do want to say, I will mention that, like CIC, for example, very subtly is doing monthly distributions now. It's been doing so for the past couple of months. Keep in mind with CI's funds, they are quarterly, they are variable distribution. This has long been, I think, for many of us, and not just me, but I think for many of you out there, that's kind of been the knock with CI is this sort of archaic, right, like quarterly variable distributions when everybody else has gone monthly and stable distributions, at least here in Canada. It does make me wonder, we're so used to the term, we're so used to putting the term income with covered call ETF, rightfully so. I don't know for sure if that's really what CI is actually after. I don't know if you were to maybe call them up and ask them, are your covered call ETF strategies and income strategies? I don't know if they would say yes. I can't say that for them because I've never called them up to. That's just speculation on my end. But elevated yields, a couple of funds going monthly. I believe this newer fund by them as well, CCBD, is also monthly, but again, it might be I might be correct. I'm not too sure off the top of my head. I'm not too sure if that one's monthly, but at least I know CIC is. So I wonder if these elevated yields can mean more consistent, higher yields amongst this group of covered call ETFs. So speculation on my end regarding CI. It'd be great to see a little bit more competition, and I'd actually really like to see CI kind of be the, maybe the potential unsung hero of this year to just, drop some big changes. And I'll tell you, because guess what? We would be talking about them more if some of these changes were to take place. 10% plus yielding, stable distributions, monthly distributions. I think those are some pretty easy changes I think that they could make. But, what do I know? I'm just a guy on the internet just talking about this stuff. Okay, let's move on let's get out of CI. Let's go down to Evolve. What do we got from Evolve? Lots of funds here, but we'll filter it by some of the highest changes. Base, this was on my watch list for practically the whole year. I've done a video on Base of probably earlier last year, just a video on wartime investing and how Base could be a really good play. I have never seen Base at this yield, 11.2%, when historically throughout all of last year it sort of just was in the 9 to 9.5 range. And then within the last 2 months or so, you could even call it 3 months, just a little more weakness on the materials and mining side of things. It's not. I don't believe, I wouldn't consider it a gold ETF. I mean, many of the other mining ETFs on the CoveredCall ETF side of things, or at least in the Canadian landscape, you'll see a lot of gold mining, and so those have done well. But I mean, the numbers don't lie. I mean, opportunity here, if mining is something you want to get some exposure to, might be worth checking out. What else do we have here? Probably worth mentioning again, utilities, interest rate sensitive. Utes is all Canadian with telecoms and pipelines and more traditional utilities like Emera. Hydro One might be in there off the top of my head. I can't remember, but at least those are the industry subsectors that you can expect with a fund like Utes. At the highest yield it's been at, 25% leverage. Utilities, again, this might be a period of weakness worth taking advantage of if you're looking to add a bit of utilities into your portfolio. Even healthcare, I think, is another worthwhile one that we're going to see throughout the rest of the tracker here. 11.8%. Again, historically hasn't seen that much weakness. Okay, so some of the elevated yields there. Let's move on to the next one, which will be, let's go Global X. And what do we got for elevated yields in here? Okay, no surprise. ENCL, the all-Canadian oil and gas equity CoveredCall ETF. This is a fund I've owned. I will own it again. Right? People are kind of maybe a little bit scared off by Canadian oil at the moment, especially with Trump coming in, the threat of 25% tariffs, especially with a current hostile government that we got in place when it comes to energy. I mean, those are a lot of negative factors in place for oil, but long-term thinking, what does oil typically do? If you look at the trend of oil over the last 20 years, it's had its ups, it's basically traded at the same price for 20 years. So will that trend really change? I mean, 20 years of history kind of say otherwise, but again, this might be a real great opportunity to capture some ENCL or some ENCC, right? ENCL is just the 25% leverage version of ENCC. Again, once I sell my place and I get into a non-registered account, I'd be picking up ENCL in a heartbeat, no problem. It's probably been again, is this the highest yield it's ever been at? Not the highest, but it is approaching the highs that it saw back in January and February. Again, continually trending down. I also suspect, I mean, everyone's not exactly bullish on Canada right now. I think there should be some room for optimism actually in Canada right now, while many other pundits and people out there are saying, get out of Canada, invest money elsewhere. It is quite clear that, right, a new government, Pierre Poilievre, is quite clearly the heir apparent. Especially the polling doesn't lie. The projected seats in the House of Commons it would be the biggest majority in Canadian history. So barring some sort of unexpected, left field strategy from the Liberal Party, maybe they, if they truly boot out Justin Trudeau, get in someone like, what's his name, Mark Carney, Trudeau's finance advisor for the leadership position, maybe that steals some support away from Poilievre. But as I was saying, to be a little bit more positive here on the Canadian side of things, I do think once we do have a new government, and I think there is just something about a new change in government, a renewed sentiment in your country that gives you some more stability, not just as an individual, but for businesses as well. I think you probably see a quick, albeit small, but just maybe enough just to see that a government change probably does enough to help bring back some businesses that might see a new government as friendly, especially for their businesses. And so I think oil would benefit from a sentiment change. Honestly, oil always benefits from a sentiment change when it comes to people really realizing like these are just cash flow rich companies. And we saw that throughout, in 2022. These companies did extremely well and did really well for their investors. So again, energy I think is going to just be the at least for Global X's sake, as far as a fund that has shown weakness. ENCL and ENCC by far biggest opportunities on the Global X side of things. GLCC, I believe this fund has actually done did really well in 2024. You're looking to pick up some gold. There's a little bit of weakness there. If you really want mining, you want the most hard hit fund, it's probably based by Evolve ETFs. Okay, so let's get out of Global X. We've got a couple of other fund managers to touch on. Not many left here. Hamilton. Let's go by the change. I would suspect EMAX. Yeah, EMAX is right at the top. Kind of no different than Global X. You got gold producers, energy right at the top of the heap. Is this the highest yield we've ever seen from EMAX? You know what? Yeah, it is. It's the highest yield we've ever seen. So, EMAX as opposed to ENCL, more geographical diversification with EMAX, no leverage. So MER is certainly going to be a lot lower than the 25% leverage that you see with ENCL. So up 8.5% for the yield. Again, might be a decent time. Pick up one of these weaker sectors at the moment. Will we see more weakness from these sectors? That's always going to be the question. Maybe you're looking to lump sum invest. I mean, maybe it might be worth considering over maybe a period of a few months, maybe just dollar cost averaging if you're looking to, you expect a little bit more weakness, but unsure that there could be a rebound. You know how fickle markets can be. Things can turn around in a heartbeat on news, or if a canal is shut down, if a rig explodes somewhere, or a particular country, or war. You never know. So, but that might be a way to play one of these weaker sectors over the next couple of months. Just dollar cost average into them if you want to get your full position in there and capture a little bit of further downside weakness. Okay, let's go on. We got two more funds to talk about here, then we'll move on to distribution changes. Harvest. Let's see what's going on with these guys. Again, some elevated yields here. U.S. banks. This has got to be the highest yield I've ever seen from Hubble. It's got to be 8.9. This is, well, I mean, no, it's not the highest yield we've ever seen. Definitely higher back earlier in the year, but again, weakness currently in U.S. financials at the moment. They had a pretty good year overall in 2024. It's just over the last, many weeks that we've seen this weakness here. We're also seeing, now this might come as a surprise, we haven't seen from all the other fund managers tech being in the top, being a sector that has suffered. It hasn't. It's just that funds like HTAE.U, HTAE, these funds saw a distribution increase. So that's why you're seeing this big yield change. It's not because tech's been suffering. It's just this has seen a distribution increase amongst another couple of harvest funds as well. What else do we have here for weakness? This is their energy fund, HPF. I believe this is probably this. Now this has got to be at the highest yield it's ever been at. Yeah, this one has never touched 10%. Kind of much like Base that I had mentioned earlier with Evolve ETFs. Never touched 10%. Base is at 11.2. Holy smokes, that's those are some terrific yields for, again, mining play, energy play if you want more geographical diversification, and maybe you want a little bit more of a modest yield. You don't want anything crazy like 18% from ENCL or EMAX with its, I believe, 13%. This just gives you a little bit more, maybe a little bit more sanity if you're more of a conservative income investor that way. And then, oh, you know what I have in here? I got actually a mix. Sorry about that. I got a mix of Hamilton. Just noticing that now. Okay, so now we're just only harvest. What else can we talk about with these? I don't think there's really anything else. Again, healthcare kind of up there. A lot of these yields are just across the board when it comes to harvest. You see pretty much every sector you can possibly see with elevated yields. I think lastly, we'll go to purpose, and we'll get rid of harvest. So this is the last fund manager we'll look at, see what's going on with purpose. Now I've kind of more considered these guys more of a niche covered call ETF fund provider, but I think that title is kind of getting stripped away a bit. I say niche because for the longest time they had single stock ETFs and Bitcoin ETFs, at least for the covered call ETF strategy. That's quickly changing with Harvest getting into the single stock covered call ETF sector, kind of stealing a bit of thunder away from Purpose. But they are still the only fund managers in Canada that offer up covered call ETFs on crypto. So you can see that with Ether, you can see that with Bitcoin. Right now, no shock, Bitcoin and Ether taking some of the, at least for Purpose, these are some of the weaker side, very, very volatile and sensitive. If the market takes a bit of a plunge, these are going to be some of the hardest hit ones. So that's just sort of the ride you take when you buy the ticket to get on the crypto train is that volatility that comes with it. But then again, let's just check out some of the yields. 12.62%. It's been higher before. But obviously since the election of Trump, unit price probably skyrocketed on ETH and BTCY over November, December, and then obviously into January. Lower markets, meaning that these yields can rise a little bit more. So we've looked at pretty much every sector. We'll quickly look at the distribution changes for covered call ETFs. There's not really much from this month, but what I like more than just here, this is what I'm going to do. I'll put it right there. What I like more, obviously I like distribution increases, but I also like just stability. Okay, I'm going to make up my mind and just put it up here, just so that you can actually see some of these numbers. So monthly changes, a lot of the CI stuff that we had mentioned, their distributions increased quite a lot. Again, their distributions being variable, volatile. They're usually you see them kind of at the top and at the bottom end of things when they have they declare distributions every quarter. You see a bunch at the top, a bunch at the bottom, but we're seeing a lot more at the top this time. So that's why it gives me some speculation that maybe something's going on behind the scenes. But through the tracker, all that stuff is visible. All those kinds of changes are captured, and obviously for me, because I'm in this thing quite a bit, it becomes a lot more visible, and I can just see it a lot more easily. Okay, so we got CI. Who else do we have in here? I also had mentioned U.S. banks, Hubble.U. Some of the tech funds by Harvest saw a bit of a distribution increase. I own, where is it? HTAE. So I get to benefit a little bit from this. I absolutely adore distribution increases. That's obviously as markets rise. This is sort of the nice trickle down effect. Is that there's more call options being written on funds with higher net asset values, so they rise to keep up. And as long as markets keep rising, these distributions ideally will rise as well. It's never a guarantee, but we can maybe expect well, I shouldn't say but speculate that there's just a higher chance that at least some of them will probably rise on a given year if these certain sectors or if the market overall is rising in general. So anyway, those are really the only other ones. Hamilton, they rise a little bit, but they do fluctuate a little bit month over month. They fluctuate, but never enough that I would consider it anything serious. That just is the nature of distributions and call option writing, is that they tentatively are a little bit variable, but the fund managers have manufactured stable distributions. So we're very used to that. But again, when we see a little bit of 1%, 0.5%, shouldn't be surprised by that. Nothing to worry about. And then, so again, we're looking at this column on the side here, monthly distribution change by percentage. And we can see it's just awesome to see that this industry is stable, especially here in Canada. Really no changes other than some of the Hamilton funds we talked about. Some of them change on the positive end, some of them change on the negative end month over month, but nothing ever to really get too worried about as far as that's concerned. So we've reached the end of the video here. So if you like what you saw, hit all the buttons of the like and subscribe variety. And if you like what you see with the tracker, pick it up for yourself. $50 is only going to last for January, then the price will move higher. So with that being said, let's see you all in the next video.